data. So right now we're looking at a slide that talks about the trending patterns. So when you're working with conventional charting patterns that AutoChartist uses, you're looking at the falling wedge, rising wedge, your channel up, your channel down, as well as head and shoulder patterns, and finally the flag pattern. These are known as your trending patterns, okay? And you'll see that wedges and channels are strictly trending patterns, and we're looking for patterns that have like a 6+ rating to determine if these initial trends are strong or not. So you can see that here's an example of a flag pattern. You can see that they are characterized by these parallel lines, and so that's really what we're identifying as a trending pattern. So when you start to see a trending pattern taking place, you can move back and forth to the Fibonacci area to see if this corresponds with another pattern that's taking place in terms of the Fibonacci retracement patterns. Okay? In other words, there may be an extension pattern taking place that indicates that maybe overlaps with this target zone. The main thing, though, is you want to know what the trending patterns are, and a flag pattern is a trending pattern, and you can see that it's characterized by this these parallel lines. Same thing with this pattern here. This is a channel up. You can see that the market has a series of higher tops and higher bottoms inside parallel lines. Okay, if you see this pattern taking place and it shows up in the emerging section of AutoChartist, you may want to switch to the Fibonacci pattern section also to see if this market is if it's making a significant turn at this support level, and that if AutoChartist has identified any key retracement areas or a Fibonacci pattern inside of this triangle. You have to remember when you're looking at this particular pattern, it's going to show up in the emerging section. When you see it show up in the emerging section, all you're being told is that conditions are ripe for this market to possibly make a turn to the upside. You have no idea really where it can go or if it's going to break through. And so if you look at the Fibonacci patterns, you want to take a look at the same market, and you want to see if it's identified this low here as a significant turning point, and if it can give you an idea of where the market can go to. If it shows you that its rally may be limited to a retracement point inside this channel, then that may be some point that you want to get out at and maybe reassess the trade. If it shows you that the market is stronger, is strong and it's exceeding these retracement levels, then you may want to look for this market to drive even further. So those are two reasons why you want to look at trending patterns and a Fibonacci pattern. So you want to make sure that you're not limiting yourself to the upside, and you also want to make sure that you're not thinking in terms of a big move when you have certain Fibonacci retracement points in the way. All right, in this particular pattern, same situation is taking place on a 15-minute chart. You have a trending pattern, you have a channel down pattern, and this market made a significant turn off this support line, okay? And when you get this pattern and you see it on the emerging chart section of AutoChartist, you again want to switch to the Fibonacci area, and you want to see if something is taking place that indicates this market is going to fail as in a retracement zone, or if it's going to continue up. Okay, so if this pattern, for example, showed up as an ABC D retracement area, and you're looking for it to stop at 50% or 618, somewhere in this level, at least you'll be able to identify a price zone, and you can set a price target, maybe exit the trade. If AutoChartist is not identifying this as a significant Fibonacci pattern inside of this channel, then you may want to let this market move a little bit higher and perhaps lead to a breakout. So you want to use it, again, as a tool to exit or a tool to continue with the trade. All right, let's move on quickly to another pattern that we look at. Here's like a channel up pattern that shows that the market is making a significant change in its trend because we held this support level for a while. And you can see that auto chart is set up its target zone here. When you see a trending pattern like this taking place, and you're using the short side of the marketplace, using this pattern, and you see this market with its forecast zone down here, you may also want to calculate retracement of this low to this high to create a zone here, a Fibonacci zone of potential target. And if these retracement levels overlap this auto chart as forecast zone, all that's going to do is instill confidence in you that this market may be poised for a strong setup or a retracement level. So it's very critical that you pay attention to these, when you see these patterns taking place, that you pay attention to potential areas of support or resistance or target prices. And you try to use other factors to give you a clarification or confidence that a trend is taking place. All right, let's move on. Oops, hit the wrong button there. As we move forward, we start to look at non-trending patterns. And non-trending patterns are interesting because these tend to be my favorite patterns because of this compression of the support and resistance lines. These support and resistance lines compress to a point where something has to happen in the marketplace. It can no longer stay inside this compressed range without making some move in some direction. So characteristics of these non-trending patterns is this wide range in the beginning. You can see the candlesticks are even bigger, and then a gradual compression to the point where these lines are actually going to form an apex. So the differences in a trending pattern, you tend to have these parallel lines that never cross. But in this non-trending pattern, you get this compression telling you there's impending volatility ready to take place. Now, what's critical about this and how you can combine it with the Fibonacci levels is that oftentimes when this secondary bottom is formed here that actually completes this support line, it may also correspond to a Fibonacci extension or retracement move. Okay, so if you're looking for volatility, this pattern typically indicates when volatility is likely to take place. Obviously, the longer they stay in here, it's eventually going to have to move somewhere. But as it begins to make its move, you also want to at least have some idea of where it can go. So if this particular market begins to break out, you can look in the Fibonacci pattern section and see if it's also, this pattern is also showing up in that area to give you an idea of a retracement zone that it may be targeting. Okay, even if it doesn't, you may have to do a little bit of work on your own and look for retracement zones for yourself. If it does show up as a pattern in the Fibonacci section, that's great, and you can get an idea of what the market can expand to. But if it doesn't, that tells you that the market may have some freedom to move to the upside, and at the same time, you can do your own projections of where it can go to. And of course, auto chartists on this breakout will also give you a forecast zone too. So the idea is that you want to use the mathematics that you've learned in Fibonacci retracements to give you projections that overlap with the auto chartist forecasts, and it kind of give you a cluster or an area, create an area of interest that the market is likely to be drawn to, and perhaps you'll be able to set more reasonable targets and at the same time you'll be able to see areas where you should place your stops or maybe place trailing stops. So that's the reason why you want to use these combinations. Okay. Another pattern is it's in the triangle family, is this ascending triangle. You can see that's a non-trending pattern, and once again it's characterized by a horizontal top and an ascending bottom, ascending support line. So when this market breaks this area, all right, AutoChartist identifies this target zone. But again, you want to check your Fibonacci's targets to see if perhaps this whole move is part of a Fibonacci retracement or some pattern. And if that's the case, then you're going to have further evidence that this is a valid downside target. Okay. At the same time, if this market begins to move lower and it stops, it may then begin a retracement. By looking at the Fibonacci patterns to see if this chart shows up, you may have an idea of what the market can do or how far it can go against you before it resumes the dominant trend that it started. Okay, so again, you can use Fibonacci to look for clarification as to whether the market could retrace this entire rally into a target zone, or you want to look at the smaller picture and you want to see whether the market stops and pauses for a little bit and then begins a retracement back up. Well, if it looks like it's a 3-point retracement and you're not going to take that significant of heat, that much heat, then you may want to let the market run its course and before it makes